In fact, let's chat about the market a little bit more, and of course the IT names as well. We've got Sandip Agarwal joining in the show right now. Sandip, hi, afternoon. A typical trade, or is there more to it? Because one has seen this pattern before where IT names tend to actually move up ahead of the numbers only then to sell on news. What are you anticipating from TCS?
No, so good afternoon and thanks for having me on the show. You are absolutely right. The sector has massively underperformed quite some time, and now probably people have started thinking that in the result season there'll be some positive commentary, and because of that, a lot of short positions could have been cut, or some people may have come and bought it as a defensive. But if you see the street estimates, and I am not an analyst anymore to estimate, but what I see is that this is the first time when there are negative year-over-year growth in USD terms for some of the companies, and none of the large companies is projecting more than 5-6% year-over-year growth. So this industry is in the large caps at least are now single digit, low single digit to mid single digit growth story, with not much solace on the margins also. And so the peg ratios are now 5-6 times. Same with mid caps, while their growth numbers could be looking good, but the multiple at which they are trading are at very high still. So I think uh, sector has a lot of time and absolute value correction depending on which segment you are. We still are not positive or constructive on the sector as such. We like some names in the small cap because the peg ratios there are more justifiable, but broadly structurally we think large cap still has some more time correction and price correction, and mid caps have substantial price correction in our view.
Sandeep, this is Harsh here. Sandeep, give us perspective that there could be rate cuts on the anvil. Would that be a trigger point? What are the other trigger points that you will look for to try and build a thesis that we're closer to the bottom now where IT is concerned? And if at all that were not to play out, as you are saying that there could be some downside risks, how much more would it take for it to start getting attractive in the current circumstances, in your opinion?
So I think there are two viewpoints here. So one viewpoint is that at some point of time, some of the fund managers who run dividend yield funds, they will probably buy because the dividend yields are now becoming more and more attractive. In some cases, it is more than 4%. And second, some of the fund managers may decide that okay, growth is similar to FMCG, so why not replace some portion of FMCG allocation, which provides stability and defensive nature to the portfolio, and they shift some to IT. Other than that, if you honestly ask me, I think that this sector is now for a very long time to come will be a 5-6% growth sector for the large names. Now at 5-6% growth, what multiple anyone is comfortable is a individual's call or a fund manager's call, but I would not be willing to give more than 13-14 times forward multiple at max, and stocks are not yet there. So we will see the bottoming happening at probably when they are 13-14 times forward multiple for the large cap, and for the mid cap maybe 18-20 times forward multiple. That is the place where you can buy them for some uptake, some returns. But structurally, the large caps are now into mid single digit growth at best for long time to come. That is the way we look at it.
So what you're saying is that this rally will soon fizzle out, Sandeep, and it's only tactical in nature?
It is not a fundamental rally in my view, because unless someone is willing to give 4-5 times peg ratio for a 4-5% growth industry, then it is a different story. But otherwise, fundamentally, it doesn't make sense to me.
Okay. And Sandeep, what about some pockets within IT which could look interesting? What about an ER&D? Could that also be a pain point, or could that also start to see pain going forward? Is that a pocket you're liking? Some of the stocks within that ER&D pack, including the likes of a KPIT, they've fallen quite a bit. Is this an opportunity in your opinion?
So we love ER&D. I can tell you that ER&D growth as an industry will be at least 2x of the software, other non-ER&D IT services growth. But even if you see names there, you will see that they are also like trading at 4-5 times peg ratio. So the multiples are between 35-40 times to 50 times. So how can we give so much multiple for something which can grow at 10%, and let's say the player on an individual basis grows at 15%? For 15-16% growth, Why should one give a 40 multiple, 50 multiple? I don't know. So we are not, we love the space of ER&D, but we don't love the price at which stocks are available. If we have to give so much multiple, then we will give those multiples to platform companies where growth is much higher. It is a quasi consumer tech play, consumer play, and it is domestic play where the risk of external challenges are less, and they are all scaling up in a very big way. So we will give higher multiple for higher growth and for companies where we have much more clarity and visibility. So we are very big fans of platforms. We have been buying platform companies for quite some time, and we are very bullish on them. And we have replaced large portion of our portfolio of IT services in last 10-12 months through platforms. So we have exposure to tech platforms versus IT services in a nutshell. We have one or two small IT software services companies in portfolio, but they are for a very different reason.
Yeah, absolutely right. And that's the thing in the market right now, right, Sandeep? It's consumer tech which is actually leading the way. And even if I look at the moves today, look at Nykaa, Delivery, Paytm, Eternal, Policy Bazaar. Any favored picks amongst these names?
So, you already named the Mag 7 for India. I will put it that way. So I am so bullish. I believe that these are the companies which in next 10-15 years will individually become $1 trillion market cap. Very high potential of happening, because remember, we have 140 crore population, and the platforms which the big tech or the Mag 7, what they are sweating the enterprise assets or the capex assets. And what is the next asset? That is human resource. And this Indian tech platforms are sweating the manpower assets. So I think this is a much bigger, credible, and long-term story. And we firmly believe that these are our max. And why max? And it can be, India, big tech, 25-30 companies. I expect at least 25 to 30 such companies to become 500 billion to 1 trillion in the next 15 years, because we have a huge population and we have to sweat our assets, which is the human resource. And these are platforms which wonderfully do that, and they are solving critical problem for the country. So we are very bullish on them, and we love all of them.
Yeah, one can see that love come out. Sandeep, thank you so much.